Welcome to All That Matters, a show about what's really worth your attention in the markets and economy today. Join hosts Michael Antonelli and Ross Mayfield as they tackle the latest headlines and answer real questions from clients.
Welcome to All That Matters with Mike and Ross. Ross, it's the first show of the year. 2024, I think, was a good year for All That Matters. I think we had some good quality content. I think our politics and our market-related takes were actually quite helpful for clients. So we're going to keep 2025 going strong here. We're going to start off the year with, we're going to do some perspectives on the market because I think we need to talk about perspective. I think we need to step back now that we're in 2025. I think we step back and think about the market for a little bit. We'll talk a little bit about returns after some good years, and then we're going to end with some of the policy proposals that are being put out there by the new administration. So Ross, I want to put up a chart of something you created. We've talked about in our chat for a long time, a couple decade comparisons. So the 1980s and 1990s, we'll throw up a chart about what the stock market did in those two decades. I was a child of the 80s, Duran Duran, MTV, all that stuff. The 80s were a good year for the stock market. And I bet at the end of the 80s, people said it can't be as good as the 90s. And it turned out to be better. Okay, so 80s and 90s better than the 80s, an incredible 20-year period for the stock market. Now we fast forward to the last essentially 20 years. 2010s, another great decade for the stock market. Number 2 bull market of all time. The 2020s are actually doing better. And that's really, the stock market's up 100% in 4 years. Okay, that's the S&P 500. 57% in the past 2 years. Ross, we're not saying this is necessarily the same, but the stock market doesn't necessarily have to have a bad decade from a good decade, right?
No. The term perspectives is great because we need to sit back and take stock. And a midway point of a decade is a great time to do that. And I think the thing that's most important to remember is just that the market goes up more than it goes down.
Yeah.
The economy expands more than it contracts, right? We're going to see recessions. We're going to see bear markets. But the baseline, right? The base state is growth, is economic growth, is innovation. So when you have a couple good years or a good 5 years, that should be kind of expected, right? And across that 5 years, there have been plenty of things that have been designed to scare people out of the market, or intentionally or unintentionally, recession talk or election volatility or whatever it is. And then at the end of the day, like you said, we're up, 100% over that period. And you just kind of have to have the perspective of this was a great time to build wealth, to be in the market, to be invested. And these kinds of moments are so crucial to building a long-term wealth, building a long-term nest egg. You cannot be scared out of the market during these types of runs because they don't last forever. They don't last into perpetuity.
Yeah, they don't. And again, those returns I gave you, they're there for the S&P 500. Not everybody's in that. We say that all the time. Nobody's 100% in the S&P 500. So I looked up a wealth management portfolio, like a 60-40, which is a pretty traditional bond stock allocation. That's up 56% over the past 4 years. 56%. That's incredible for a standard wealth management portfolio. That's really, really good. And again, like Ross mentioned, we field calls all the time about the decline of the dollar, central bank digital currencies, politics, national debt. And yet look what happened. The 2020s are actually doing better than the 2010s. And let's kind of talk about that. Let's move into the next section. Let's kind of talk returns for a second. We know past performance is no guarantee of future results. We know that. We know that just because something has happened doesn't mean it's going to happen again. But we just had back-to-back 20% returns in the stock market. That's incredible. Back-to-back 20% does not happen all that often. Tee it up, Ross. What has history shown on something like that?
Yeah, let's just look at the last 75 years. So this is the first time it's happened since the late 90s, first time this century. Happens in 1950, 54, 75, 82, and then a bunch of times in the late 90s where the stock market was just on fire. And if you look at all those times, the year 3, right? So back-to-back 20% years, what happens in year 3? The median return is 13%. That is better than the long-term average of the market. Now, again, past performance, future returns, we're not guaranteeing that's going to happen. But what we can say is that you should not use the market's recent strength as reason alone to get bearish. If you're worried about some other thing, we can talk about it. But the market's strength alone is not a reason to get bearish. And I'll throw one more stat at you before I turn it back. The current bull market, which started in October 2022, is up about 75% over the last 27 months. The average bull market going back to 1930s is 60 months, 5 years, and 180-ish%. So we're not even close to just getting to what an average bull market looks like. So strength begets strength typically in a stock market. So I think that's important because it is outside of the policy stuff, it's the number one question I'm hearing is Should I take some chips off the table because of how strong the market has been?
I mean, could the stock market go down this year? Absolutely. There's no way Ross and I would say that it couldn't. Okay. And any 1 year basis, really anything can happen over a 1 year basis. I think history has shown that. We know that the world's a crazy place. The stock market in the 2020s has actually done so well, okay, up to today, that even if we got 5% returns for the rest of the decade, that would be an average decade. Now, listen to that again. We're doing so well that even if we got subpar returns the rest of the decade, just 5% a year, it would still give you the average return over the long run. So it's been really good. I think the perspective that we're trying to portray here is that as an investor, these are the times that you have to be building your wealth. If you're always scared out of the market, when are you going to get in? When it's scary? Of course you won't. You need to be in it now. History has shown that back-to-back 20% years are not a reason to be afraid at all. But you do need to understand that over any 1 year basis, quite literally anything can happen. But it's been quite strong. Even with COVID and a bear market, Ross, I like the stuff that's happened over the past 4 years is remarkable to me. Yeah, and yet we're here talking about it being better than the 2010s.
I know. Two bear markets, two of the worst bear markets in the last 50 years. Highest inflation since like the early 80s. I mean, all sorts of wild stuff. And yet you kind of like take stock at the midpoint of the decade. And wow, I mean, that's all you can really say.
Yeah. So we have a new administration coming up. Let's move to our third section, some of these policy proposals. Ross and I are going to be talking about three different things, probably during the year, certainly at client events and certainly kind of online with our advisors and their clients kind of one-on-one. There's three things: immigration, tariffs, and kind of tax proposals. Let's tackle immigration first. The question always is, does immigration affect the stock market, right? Is it a stock market thing? I always say, how does it affect the earnings of the companies in the index? And it does, Ross, but before you tell me why, I think you have the answer for our listeners here. Let's just do some stats about immigration in the United States. Take a look at this chart from the Department of Homeland Security, and you'll notice that the amount of deportations is kind of varied widely over our history, but if you were to average that out, on average, we deport about 1 million people per year. So that's about what the data says. So it's not unusual. This has happened for a long time. There's big numbers. There's kind of average numbers. But Ross, does it affect the stock market?
Yes, it could. Now, I want to caveat it, and I think you would agree, is what we're talking about right now is something between policy proposal and campaign rhetoric, right? And we know anyone who's running for office or trying to get elected, what ends up being the policy once it makes its way through agencies or Congress or whatever it is, it might look very, very different when it's implemented. We saw this in Trump's first term. We saw this in Biden's term. We've seen this through the course of history. So we're talking kind of broadly here. But broadly, yes, we have, generally in this country, a shortage of labor. Part of it is demographics. Part of it was there was a big drop in immigration during COVID when everybody was kind of hunkering down. And if there's a shortage of labor, what it does is allow the remaining labor to ask for higher wages, and higher wages put pressure on prices throughout the economy. It leads to inflation. It can lead to higher interest rates, and that can impact the stock market. In fact, as we're talking, we're seeing what higher interest rates can do to the stock market. So if we have a tighter labor supply because we're deporting available workers who are willing and able and want to work, it could push up on wages. And I think that's the main story, right?
And I dug a bit into the sectors of this stuff because I wondered, how should I think about this? This debate is really centered on a couple different sectors. So construction, agriculture, kind of the service industry, the restaurant industry. That's where this debate is mainly centered on. And that's something we're trying to watch for. Is the market saying anything in those sections? But really, it does boil down to inflation. As to Ross, it seems like everything seems to boil down to inflation nowadays. But less workers, does inflation rise? That will be what the market will try to think about as we kind of tackle this issue. The second one we want to tackle is tariffs, which, if you remember 2016 to 2020, which I do, I was a trader back then. I wasn't even in private wealth. We heard trade war stuff, tariff stuff all the time. It was always in the news. President Trump would always throw out a tweet saying, I'm going to do this to this country or this to that country. We will be talking about this a lot over the next 4 years. He's already doing it. So does that have an impact on the market and inflation? Maybe, but again, it depends, right? What does it depend on, Ross? There's something that all this tariff stuff depends on, and it's razor thin, right?
Yeah, I mean, it depends on what can actually get passed and implemented again. I mean,
what has the votes?
The stuff that runs through Congress. I mean, there is literally as small as the margin in the House can get is where we're at. Yeah. They can't lose one vote today. The Republicans cannot lose one single vote. There can be some stuff done with executive action, but I think what you said is the main thing, right? Is a lot of this is public negotiation, right? It's putting pressure on other countries, other leaders, strengthening the negotiating hand to extract whatever they might want from country X or country Y. As you mentioned, in the first Trump term, we heard about trade wars and tariffs like literally nonstop. It was the main talking point. Go look at like Google Trends. I bet it's all over the place. And yet from 2017 to 2019, so first Trump term before COVID throws a wrench in everything, inflation is 2.1%. That's the average, right? It never spikes. It never plummets. The tariff rhetoric and the tariffs that got implemented, and maybe you can talk about the ones that got implemented and stayed implemented, never had a huge impact on inflation. Could be different this time, huge caveat, but it wasn't inflationary the first time around. And I think that would surprise a lot of people because of how it's talked about today.
I mean, a lot of the tariffs that President Trump put in his first term were never removed in President Biden's administration. They were never removed. In fact, they added a few more on China, on kind of some high tech computer related parts. But those tariffs that President Trump put up never got removed. Never got removed. So what we're talking about here is a lot of like online discourse, a lot of public discourse about negotiating positions. I think that's the best way to think about it. So try not to overreact to some of the tariff stuff that you see. We have to wait and see what can pass. They have razor thin margins in the House. What do moderates think? Remember, moderates can really kind of shut down anything kind of unusual. Are there executive privileges, executive powers? Sure. But we need to kind of monitor this stuff. A lot like our third topic, which is taxes. Taxes, I know, is on everybody's mind. There needs to be an extension of those TCJA that will be negotiated. I've even seen things like salt, the salt taxes being negotiated. And again, Ross, this is one of those situations where we just don't know enough yet to make any sort of decision. We have supreme talent, Tim Steffen. We have this tax department of the Bear that's so good, but we just don't know, right, Ross? There's just no answer yet.
Yeah, I mean, this one in particular is going to have to go through Congress, and so there will be negotiation. I think it's a big priority, so it'll probably be early and often. We'll hear a lot about it. The market, I think, clearly wants it, even if it's blows out the deficit a little bit. But yeah, it's just we just don't know. We'll be there when we do know. We'll be there with the tools and the solutions, and particularly on the planning side. But until we know, we just don't know. And so I want to leave with one thing though, because we're talking about policy proposals and rhetoric and the kind of noise of the way that this administration publicly negotiates. S&P 500 in the first year of a presidential term, let's just do the last 5, 28% in 2021, 22% in 2017, 32% in 2013, 26% in 2009, 5% in 2005. So you have 5 straight years, strong gains, including Trump's first term, which was a very noisy year by the headlines, 22%, one of the quietest years in stock market history. The market is going to focus on what matters and let all of the noise fall to the wayside. And that's really why we're here. It's why you named the show what we named it, right?
Yeah. I mean, honestly, the reason we do this is to try to get rid of all the noise. And you are inundated by it constantly, whether it's negativity or whether it's political stuff. Like, if you just stay tuned to us, if you watched us in 2024, I hope we kept you on track. I hope you kind of listened, because we're not here talking about nonsense. We're not here to scare you. We're not here to literally post things that might be counterproductive to you. So please stay tuned with us, Ross. 2025 year, it's going to be a great year. I'm excited again. We will be here no matter what happens, though. And stay tuned, everybody. We can't wait to see what happens.
Thanks for watching All That Matters. Opinions expressed in this episode belong solely to Mike and Ross and do not necessarily represent the opinions of Baird. This program is for informational purposes only and should not be relied upon for any investment decisions.